Hey everybody, it's Bob at Trade Genius. Pre-Thanksgiving bear talk coming at you. Stay tuned.
Trade Genius.
Okay, Phil, I don't think we've even been bearish enough, but this chart actually started me to think about buying a cave somewhere for the next bear market. You want to walk through the math on this thing? It's absolutely insane.
Yeah, like we've been saying, we're in a wave five of a wave five, and this is a bigger zoomed out multi-year look at that bigger wave five structure playing out, and this is the blow off move. So we're seeing the finale of this, right, and going into what we think is going to be our blow off move into maybe December or January into that inauguration. But that is a significant top in what has been just an absolute ripper of a move ever since really QE was introduced, going back to the great financial crisis. So this is the culmination of all of that. And we've had a higher stock market, yes, but we've also had a lot more inflation. So the power of the dollar has been destroyed in this move. And wages haven't been keeping up and things like that. So the regular average Joe, although maybe his 401k is up, the real standard of living hasn't increased as much as this stock chart would imply. So basically what we're looking at now is like the valuations of things, right? If we go back to the last bubble top, which was the great financial crisis, the S&P 500 price to earnings ratio was at 17.36, Bob. We are currently at 30.13, right? So we're way overvalued even in terms of that last top. Then if you look at the market cap to GDP ratio, and this is what Buffett looks at, right? And this is why Buffett has been building up cash. We're at 208% now. Back in 2007, where we were at our last peak before a big recession, 105% was the market cap to GDP ratio. And then in not the great financial crisis, but the tech bubble, we were at 137%. And if you were to even look at this in terms of the Great Depression, even then the market cap to GDP ratio, because it's a relative measure, was only at 87%. So the valuations have grown and grown and grown, and just bigger and bigger bubbles. And that's why we're very careful up here, because the pullback could be quite significant. I mean, if you look at this chart here and you look at what potentially you could be doing, you could easily shave off 50 or 60% from these levels back down, still maintaining a large trend higher. But man, what a hit on your 401ks. And if you're near retirement, that's why we haven't talked about that, but a few months ago we mentioned if you're getting closer to retirement and you are counting on the value of your 401k to be at these levels, you need to start getting out of the market, because we've come too far now, too high, and these valuations historically are at peak levels.
Look, you're looking at a 60% minimum sell-off. That's including if earnings stay the same. Typically earnings will trough and the PE will trough around 9. When people talk about Great Depression kind of moves, well, you can Eiffel Tower this move down 80%. So, we're sitting at 6,000. You can actually see a market trading. And I always said way back before the 2008 crash, Phil, that we're going to go back and touch that 1,800 level in S&P 500. And I think that's really, really possible. You can't even imagine ever creating enough cash to justify any of these valuations. But, we're on a derivatives, joyride right now. So you have to kind of, hit it and quit it and hit it and quit it until it decides to blow up on you. But the good news is, Phil, is that there are actually product structures out there and ETFs that we could trade to protect ourselves and actually make massive amounts of money on this down move, because this won't go down like, straight down. It's going to stair step down, and there's going to be some tremendous trading opportunities here. And we have those trades. In fact, we're starting to leg into those trades more and more now, the closer we get to the inauguration. Now you can see why probably nobody in the Democratic Party wanted to be president, okay? They're looking at this thing too, and they're hoping that they can hang a Hoover label on top of Trump. So this is my biggest thing to be concerned about is that, the stock market is kind of a scoring system, even though 60% of the people in the United States aren't in the stock market, but you're affected by the stock market because rich people have money in the stock market and they'll react accordingly if they start losing money. So get ready, guys.
Yeah, and then one thing too, Bob, if you notice that line on the chart, that's roughly the weekly 200 moving average. And that is when you go into a bear market, you're going back to that line and you're going to go under that line. So that line currently sits at about 44, little under 4,400. And where we, if we do pull back, let's say we roll over into Q1, where we meet up with that, maybe that's somewhere between, 4,400 and 5,000. But that's your first downside destination. So if we end up at 6,100 or 6,400 in some blow off move, that's at minimum, that's your first pullback. And when we go into a bear market, you always fall through the weekly 200. So that you end up making a low well below that. So that's the kind of pullback kind of size of move at minimum that we would be seeing. And likely we're going to see lower than that level. So that's something to keep an eye on that charts is if you're wondering how far down we can go, always in a bear market, you break through that 200 weekly moving average.
Yeah, and remember the first move will be violent, and then they're going to try to lift it, and that's the lower highs where you really want to get heavily short. The first down move is not going to be as violent as the second down move, just like when wave 1, 3, and 5 down. So it's that C wave, the 3 wave, whatever it is. That's the one that'll Eiffel Tower you. So
yeah.
So anyway, be warned. I still think people, they're going to absorb a lot of buying here into the new year because people won't want to sell their cap gains until we get into the new year, and then we're just going to take it from there. So anyway, enjoy your holiday and enjoy the Bitcoin move. We had a little bit of a scare the other couple of days ago here. People are expecting moonshot for Bitcoin, pull back, but Phil, let's give him 2 seconds here. It looks like it's trying to buy it back, and if we cross that 100, then just strap in.
Yeah, if we, I think there's going to be some consolidation, right? As 100 is such a huge level, and I think there are a lot of people, long-term hodlers, have been targeting that level to cut some loose, which you can't blame them, right? It's been a long, holding for how many years. But I think we consolidate under it, Bob, and then like you said, once we crack over, I mean, you could even peekaboo over it and then come back in and still consolidate a little bit more. But eventually we'll crack through that. I think seasonally you could possibly see another week of consolidation, and then that December timeframe should be explosive to the upside.
So stay tuned, guys. We'll talk more about that on Friday. Anyway, talk to you later. TradeLikeAGenius.com. Couple days left for the Black Friday specials. A lot of people are join with them and make money. We had another great day in the markets here, so I look forward to seeing you. Thanks, Phil.
Trade Genius.